Today we are going to start with part 1. First of all, what this class is not about. This class is not about get rich quick scheme. None of you will become rich Monday morning. Your life will stay as it is right now. Your portfolio will stay as it is doing right now. So no get rich quick scheme over here, or generating 5% return or 2% return or whatnot. This class primarily is about understanding options, not memorizing the setups. I've shared one setup in the options group, for example. We are not going to talk about those setups. It is just about understanding options intuitively. What we are going to do, we are learn the basics, and we will learn that by participating it and by doing it. Okay. Mostly the important bit. Anything which I'm not going to talk about today, just think about that is not important for options. I'm not going to stress or emphasize something. Just think of it as that is not important as a beginner for you guys. Now, here is a question for you guys. What do you see here? What is this, guys? Any guesses? And the class is all about participation. We all have to participate.
Nuclear fission.
Oh, chain reaction.
Yeah, chain reaction, nuclear fission. That is correct. I'm going to show you another image, which is this. What is this?
Electric grid.
Correct. We can say electricity, right?
Yeah.
I want to show you the third image. This thing.
Pencil lead.
Sharpened pencil. My question to you guys, what is common in all these three things? I'll show you the picture again. First one, second one, and third one. What is common in these three pictures?
Movement. There are two lines I can see that are common.
I'm sorry, someone else is drawing it actually on the screen. Just please avoid it if you can. Ajay is the host. I'm sharing the screen, but I guess that makes anybody to come and start drawing it, I think. So my question to you guys is, what do you see common in these three things? Nuclear fission, chain reaction, electricity, and the sharpened pencil.
Movement, like a direction.
Direction, movement, anything else?
Node.
Node. I'm sorry, Sunil sir.
Node pointing towards one common center.
That is correct. Anything else?
There is a potential.
There is a potential of what?
Starting point.
Degradation with time.
I'm sorry?
Degradation with time, like when we use pencil or fission or like power transmission.
Half-life.
Some
Yeah, something like that. Something like that. But there is still one more common thing between all these three things, among all these three things. In fact, two common things.
They can move in any direction.
They can move in any direction, yes. Something more.
All three are very powerful, have good potential. I mean,
100%.
Center. Yeah, there is a center, something like that.
100. I think one of you guys just said it, that all three of these things are very, very powerful. I will just take it one more level up. All three of these things can be very utterly destructive. You may wonder what this pencil can poke anybody's eyes if you think about it. Electricity can burn cities, and nuclear fission we already know. At the same time, all these three things are extremely constructive. Nuclear fission can give you a source of perpetual energy. Electricity can light cities on festivals, and we can see the uses of electricity. Pencil, you can sketch Mona Lisa, or any other art. with that? On one hand, all these three things are very, very destructive. On the other hand, they're extremely constructive and you can be creative. Guys, leverage is like that only. Leverage, think of it as like electricity. You touch it carelessly, it destroys. You control it, it can power cities. Does it make sense?
Yep.
Makes sense.
Okay, so based on that, there is something called law of leverage. Law of leverage says most of us thinks that leverage is bad, which is partially true. It is bad when used in an uncontrolled way. But leverage is powerful when you can use in a controlled way, just like nuclear fission or electricity or a sharpened pencil. Uncontrolled, heavily destructive. Controlled, very, very powerful. It all depends on how we are using this leverage. My question to you guys, do you know who created this law of leverage and when was that?
So are you talking about the history of derivatives?
I'm sorry?
Are you talking about the history of derivatives, how it started, like tulips?
No, I'm just asking this law of leverage, who coined this term, who came up with this law? You can take an outlandish guess, many wild guesses. Well, I'll keep it simple. I created this thing. I came up with this idea yesterday and I just put it together in a slide. So it was a trick question to set you up. The point is that leverage uncontrolled without understanding is very, very dangerous. But if we understand the risks and if we use it in a controlled way, it is a perpetual source, of I don't want to say profit, but it can be very powerful. All right. I want to show you two more images, guys. I want you to tell the difference. Let me show you. Take a look at this picture. Okay. And then I'm going to show you the next picture. Pictures are not very good, but just bear with me, right? What is the difference between these two pictures, guys? This is a boarding pass, boarding ticket. This is also a boarding ticket.
So
What is the difference?
color seems like a major difference.
Budget difference, sir. First picture shows first class and second picture shows economy class.
Oh, I did not notice that, but thank you for pointing that out. There is some other difference too.
First
One
picture
talks about
is
cancellation.
live.
Pre-cancellation.
The second one is cancelled.
Yes, free cancellation. First one, there is no cancellation. If you have bought the tickets, your money is gone. There is no turning back. Remember, both are allowing you to travel and to reach destination. This ticket also and this ticket also. But in the second ticket, you have an option to come out of it. In case if you want to change your plans, second one allows you with some cost. There is some cost, but not the complete cost. Both are allowing you the travel, but only one allows you the controlled exit. Leverage is of two types, the futures and options. They both can take you, reach your destination, but only with options you can come out with a controlled exit. Does it make sense? Now remember, I'm just trying to simplify these things. I am focusing on simplicity than the complexity of these derivatives, right? So what I'm trying to say that with future and with options give you, it allows you to limit your downside. Future does not. Now we have professional commodity traders, so they will pardon me for keeping it very simple and not tell you the nuances. But for now, as a beginner's level, this is what we need to know. Are we okay, guys?
Yes.
Okay. I'm going to show you two more pictures now. Now you know futures and options. Tell me here, futures or options or futures?
Second one is options because it ensures safety.
Yes. Any other guesses? Futures, options, or options and futures? Any other guesses?
In one case you're static, so I think this one is options. In another one you're already moving, so probably cannot stop.
The first one is option because you have a safety. The second one is not.
Very good. Correct. And that is what I was looking for it. Someone pointed out another difference, which is also very good, and I did not notice. But the thing is that you still ride the same road. You still reach your destination. But only one of these scenarios limits your injury. That scenario is options. That is what options does for you. Right? The one who is using the helmet, he has limited the damage before starting the journey. If you're using options in the right way, then you are going on a journey with a helmet on. The one without protection is futures. Risk is always there and open for as long as you're going to ride. Think it like this, and I'm simplifying it. So, future risk is uncapped. In options, risk is designed. You can design the risk the way you want. Does it make sense, guys?
Sir, I want to tell this also that scooty has limited speed, but bike has more speed, so it is more riskier in the bike than scooty.
Yeah, we are ignoring those nuances, those subtle differences, I guess. We are just focusing on the safety here, but that's a valid point too. Um, um,
But in that also, scooty is a small way. That wheel, that also riskier than.
yes. So the idea is that with options, risk can be designed. I'm not saying it can be eliminated. With futures, risk is uncapped. It is going to happen one way or another. You do not have any control to manage your risk. All right. So the key point with all this exercise is that controlled leverage is very good. Uncontrolled leverage is very bad. Leverage is of two types: futures, where risk is uncapped, and options, where you can design the risk you want. I'll come to the next slide. Why options exist, guys? You may be surprised. The way we use it is like that Nifty will go up, let's buy call. Nifty will go down, let's buy put. The fact is that options were not created for that reason. Options were started for the reason to define risk and share the risk. Some people want to reduce the risk. Some people are willing to take on the risk. And then the outcome of that risk sharing converts into profits. They were created basically to reshape the risk and the probability of the risk. Profitability is the outcome of that risk sharing. But most of us, when we take options, we do not talk about the risk part. We are focusing on the profit part. Profit is just the consequence. Are we okay, guys? Or is it too confusing so far?
No, I think we are good.
All right.
Sir, I have this question. Profit is a consequence, but why is it not the objective? Ultimately, the objective is profit only, right?
Well, objective is like when you have created something thinking about the profit. The options were started to keep risk sharing in the mind, dividing the risk. Profit you can have with futures also, for example, or for any other means. But options are primarily used or should be used to share the risk from your portfolio.
Okay, sir.
I have another question for you guys. Is options a zero-sum game?
I think so.
So
One's losses, others profit.
Any other guesses?
But I think like on which side you are, it totally depends. Like on which side you are, like whether you are a net seller or a net buyer of a option.
Okay, but seller and buyer, it will compensate, right? If one guy is
Yep,
making profit, the other guy will lose money.
definitely.
Yes. Let me give you an example. Chess. Is chess a zero-sum game? That should be easy.
There's a possibility of draw.
Yes, and then half points will be shared between both of those two guys. But when someone is in an advantage position, that means the other guy is at a disadvantage position. Chess is a zero-sum game. My question is a stock market zero-sum game?
No.
stock market itself is not zero sum,
Yes.
but options probably are.
All right.
Stock
So
market is a zero-sum game.
Yes, it is a zero-sum game because there is a buyer and there is a seller. So there's a buyer who buys and the seller who sells. So one makes money, the other loses money.
No, I don't think options are a zero-sum game because you could be using options to hedge something where you are protecting the loss. So even if you lose on the options, you save on something else. So
Maybe in the long run, the stock market is not a zero-sum game.
that is correct. Stock market is not in the short term. Yes, in the long run, the stock market is not a zero-sum game. Let me go to the next slide. Chess is a zero-sum game. A stock market is not a zero-sum game. It's like progress. Progress happens over time, and we all benefit from that progress. Options are zero-sum game on the day of the expiry. In between, from the time you become a participant in that contract till the day of the expiry, it is not a zero-sum game. It is a game based on a skill and experience. If you understand the risk properly, you can think of it like an insurance. If you understand the risk properly, you can benefit from the premiums. But if you don't know how to price the risk, and in no options class, I don't watch options. I don't have a reference point, to be honest, about how options class should be. So everything I'm teaching is like how I would teach to someone, a layman actually. So options, think of it as like an insurance business. If you do not know how to price the insurance you are selling for, you will end up in a big loss. So although options are zero-sum game on the day of the expiry, but before that, it depends on a lot of factors, and you can use your skill and experience, to shape your risk and to design your risk for your needs and purposes. All right, guys. So enough with the preface, and to give you like a larger picture, right? Uh, uh, are you guys? You can hear me, right? You guys are okay, right? Not very confusing so far.
Done.
Yeah, audible.
All right.
Yeah.
So now we are going to coming to the meat of it. How many types of options are there?
Two types, call and put.
Call and put. but the strategies can be numerous.
Anything else, guys?
European and US.
Sure. Anything else?
Maybe in stocks and commodities.
Sure. It's very good. There is a one more level up, like a difference is there. This was a setup question, to be honest, right? I know options are of two types. At a higher level, they are like a standard options, and then non-standard options. There is a standard options and non-standard options. Standard options are traded on exchange, which is what primarily we are going to look for. Non-standard options, they are traded in OTC. If you have $10 million, $20 million, you can go to any investment bank and you can ask them to create an option for any condition you want. We are not going to talk about the non-standard options henceforth. We will focus on standard options only. My question to you is, how many types of standard options are now?
In the money option, out of the money option, in the money option.
That's a good point, but that is not the type of option in some way, but we'll come to that very soon. And I think one of you guys already answered it earlier. Among the standard options, there are two different types: US options and European options. The difference in US and European options is that in US options, option can be exercised at any point in time if the conditions are met. So options has a criteria. Option is a contract, and it has a criteria and it has a condition. If the criteria is met, then the condition needs to be fulfilled. In US options, at any point in time in the life of that option contract, if the criteria is met, there is a chance that the condition can be fulfilled. That means if you have if you have bought an option to buy some shares, and if the criteria is met, you better have money to buy those shares, because the option can be exercised much before the expiry date. In European options, and Indian options are European options, the option exercise happens only on the expiry date. And hence you can see a lot of gambling happens in India, because from the time you buy the options, it will not get exercised till the day of expiry. So you can gamble, you can take risk. You know that option is going to expire your last day of the month, so you need to have the money to fulfill the obligations or the right only on that day. In American options, any day that can happen. You just cannot bluff. Does it make sense, guys? Now there are other differences, and we'll ignore it because you don't need to know about that. This is called a structural difference between the options. And I'll come to the next part. So we have the standard options and the non-standard options. Then among the standard options, we have the US options and the European options. My question to you is, we are going to talk about European options. How many different types of European options are there? And you all already know that there are two types: call option and put option. I am going to differ talking about call and put option, for a few slides afterwards, and you will understand the reason. For now, just understand that there are two types of options which are in India, which is what we are interested in: call options and put options. Are we okay, guys, so far? Any questions?
Yes, I have, Anil sir.
Please.
So you said that the American, basically the question is that American options you can exercise any day and you cannot bluff. So
Yes.
how is that different from? So if you buy an option and the stock mark and the underlier goes down, your option price goes down and you can sell. So how is that different from option being exercised versus you closing the position by selling or by closing the option position?
No, I'm not sure I follow your question properly.
So what I'm saying is that you said that in the American options, the expiry happens because it's a American option. The exercise can happen on a daily basis, whereas in the European options there is a set month and therefore gambling, right?
Okay. See, what I'm saying that in US options, option can be exercised at any point in time for the life of that option contract. You can sell anytime. You can sell US options also. You can sell European option also, right? But in European options, automatically, as a contract obligation, it will not get exercised. You can close the
Correct.
option. That you can do anytime. Buying
Yes.
and selling happens all the time. But automatically, it will not get assigned to you. It will not get exercised before expiry.
Understood. So American option gets assigned and exercised every day, is what you're saying.
No, so it can. It
It
does not
can.
get
Okay.
assigned. It can, and there are some market rules for that.
Oh, okay.
So it has to meet the criterion for that option contract. But besides that, there are some market rules, the economic rules. If that happens, then it will get assigned. You better be very careful. But as long that
Understood.
those market rules are not meeting, then you are fine. I hold roughly 300 option positions right now, US option positions. You got to know the market conditions when, even though it is in the money options, and I have not talked, so I will explain that later, it will not get assigned to me.
Understood.
All right. So we will think of it that in European options, there are two types of options, call option and put option. And I'll come to these later. I want to talk about few other things like option terminology. Let's see that. And so far, any questions, guys? Anything which is confusing to you?
So I think, Anil sir, when you are talking about the US options, but I think generally in Indian market when we trade in Nifty's option and all these series, so they are generally European options. Am I right?
Correct. Because Indian markets are European options.
Yep. So basically, like if we are looking for Indian market only, so I think our main point of discussions and strategy going forward
100%.
to Europe options only.
Yes. And yes.
Thanks.
Are we okay, guys? All right. I want to talk about the option terminology, right? The jargons. Once we understand the jargon, everything will become very, very easy actually. So let me show you. Option is a contract, and any contract is going to have two parts, a buyer and a seller. The contract is written on any particular asset. That asset could be a stock, or that asset could be an index ETF. So the option contract has the underlying asset all the time. Without that, you cannot have a contract. An option contract also has a lot size. And that is another difference between US market and Indian market. In US market, the lot size is standard lot size. It is always 100. In Indian market, the lot size depends on different scripts based on what, different companies, the lot size is different. It is kind of confusing, but perhaps for this demographic, that is the right thing. What lot size means, that when I talk about one contract of Apple option, Apple is traded in New York Stock Exchange, it means that we are talking about 100 shares. When I talk about one contract of Microsoft option, we are talking about 100 shares because the lot size is fixed in US. But when we are talking about one contract of Infosys, the lot size could be 300, and I'm making that number up, I do not know. Whereas if we talk about one option of Nifty, the lot size could be 65. Whereas if we talk about Bank Nifty, the lot size is 25 or something else. So lot size is different in India for different companies. Then the third point is strike price. At which point the option become eligible, basically at which point the criterion for that option contract comes into picture. So let us say that Nifty is trading 25,500 right now. If you want to take a future contract, well, forget about future, let's ignore the future completely. Let us say Nifty is talking about is at 25,500, then you can have an option contract for 25,500. You can have an option contract for 25,600, 700, 800, and you can have the option contract for 25,400, 300, 200. These are strike prices. And then there is a condition, and then there is a criteria, and then that criteria enables the condition for that option contract. Everyone okay, guys?
Yeah.
Yep.
Each contract has a defined expiry. It could be the next day. In US, it's a 0 DT. We are not going to talk about US anymore. It is a weekly expiry for index options in India. It's a monthly expiry for stock options. Each month we are going to have some expiry. So we can buy options, Infosys options for the month of February, for the month of March, June, July, whatever. Or we can buy Nifty options for this Tuesday, the next Tuesday, the following Tuesday, the end of the month, next end of the month, 5 weeks, 6 weeks, like that. Index options have weekly and monthly expiry. Equity options have only monthly expiry. After these common things, there comes a call option and a put option. Remember, excuse me, each option contract has a buyer and each option contract has a seller. Buyer always pays the premium. If you're going to buy something from a shop, you will pay money and in return you will get some product. Same thing happens in options. You buy some option contract and the product you are getting is a right for something, and we'll talk about that something if the conditions are met. Remember, options has a criteria and a condition. If the criterion is met, then you get the right for that condition. Buyer is paying the premium. If the criterion is met, then he gets the right to exercise the condition before expiry date. Seller of the option contract receives the premium and he has an obligation to fulfill if the criterion is met for that condition till the expiry date. Does it make sense, guys? Or have I confused you?
Can you repeat once, sir?
Can you repeat once, sir?
Sure. So far I'm talking about everything which is applicable to both call and put. I have not differentiated call options and put options. That we will do in the very end because it's a one line difference. That's all. If I teach you call options and I change one line, you will know put options. So everything I'm going to say is applicable to both the options. Is everywhere. Each option has a buyer and a seller. Buyer has to pay the cost, which is called the option premium, and he has the right to receive the product. That product could be anything. All right, that product is the condition for that option contract. Buyer pays the premium and he earns the right that that condition will be fulfilled, as per the option contract if the criterion is met. Seller, on the other hand, gets the premium and he has an obligation to fulfill the condition if the criterion is met. Buyer is paying the premium, seller is receiving the premium. Buyer has the right for the option contract condition, seller has the obligation. Are you guys okay?
One question. When you said the seller has the obligation, if the condition is met, but the buyer has the option to, buyer has a choice and seller has obligation, right? In case the buyer does not exercise the right, then seller can also have an option, or seller will always be obligated and the trade will be done.
So this is a good point actually. So what will happen if the criterion is met? Okay, everything has a criterion and we'll talk the criterion in the very next slide. If the criterion is met, then if you have that option on the day of expiry, the transaction will happen. Exchange will do that for you. But if the criterion is not met, then the transaction will not happen. The option will go, waste. The contract is not needed to be fulfilled because the criterion is not met. But if you own the option on the day of the expiry and the criteria is met, then the transaction will happen overnight automatically for you. That means buyer either has to buy shares, either he will receive shares or he will get to sell the shares at the predefined strike price. Does it make sense?
Yes. Yeah. Thank you.
So far, guys, everything I have said is common to all the option contract. There is no difference. And in the next slide, we are going to talk.
So one question, sir. So does that mean buyer purchases a criteria that he thinks that will get met, essentially, like a favorable criteria?
Yes, 100%. 100%.
Yeah.
So let us see the next slide. Before I come to call and put, I want to tell you like a few more concepts, and that'll make things simpler. Because the difference is going to be the condition. Okay. So few more terminologies. Naked position. When you talk about a naked position, remember buyer has the right. So naked position has no meaning from buyer's point of view. Naked position has a meaning from the seller's point of view because seller has the obligation. So if you are a seller and you have only that one position, then you are on the hook to fulfill that obligation. That is called a naked position. You are on the hook to fulfill some obligation, and that risk is not offset anywhere else. Then we can say that you own a naked position. In simple words, well, think it like that only. We will talk about call and put, in 2 slides afterwards. If you have an obligation, and if you have not offset that obligation somewhere else in some other form, then that is a naked position. Hedged position means you may have an obligation, but then you are fulfilling a part of that obligation from somewhere else. That is called a hedged position. And you all may know, some of you may be using that position, that hedged position. The reason I want to talk about it here is not the difference. I want to tell you guys that as a beginner, you should always have hedged position. You should never have an obligation only position, a position where you have an obligation and that is the only position you have. You should never ever have that. As a beginner, you should never have a naked position, and as a professional, you can think about having a naked position. Think as much as you want, but then have a hedged position. If there is one thing which can blow up account, that is owning a naked position. Is that okay, guys?
Yeah.
Now,
yeah, one question. So you are saying that for naked position, a loss will be uncontrollable. Means
remember, I am not talking about profit and loss. I'm saying you have an obligation.
okay. So we
You
have
have
to
an
fulfill.
obligation. That obligation could be anything. It may turn into loss, profit. I mean, we don't even want to talk about those terms. It's about risk.
So the risk is maximum in naked position.
Yes, you have an obligation to fulfill, and that is not supported by anywhere else.
Okay. Okay. Sir.
Guys, I'm sorry. Okay, so you should never have a naked position. If you're a professional, think about having a hedged position. Think about having a naked position, and then do not have it. It's a bad thing, and it just not worth it. I have more experience than pretty much anyone in India because I'm doing it for 25 years. And I'm telling it very carefully that you should never have a naked position. Alright, this is just to understand. Next thing.
Sir, by naked position, do you mean that we only have the contact, the option contact on selling side?
Correct. It's always the selling one that has the obligation. Buyers have the right. So buyers do not have a problem. They have a right to exercise. They may not exercise that. I mean, whatever. But sellers has the obligation. That is where the problem comes.
Can you please go to the previous slide? Can you explain with the example of like this hedged position? Does it mean that having the same contract for both selling and buying?
Well, it could be a similar contract. It could be in another form. Okay. You can have an option supported by stocks. You can have an option supported by futures. Variety of things. So it doesn't need to be exactly similar type of contract.
Okay. For the same stock or?
Well, again, I'm not going in the details.
Okay.
You can hedge, for example, you can hedge, Nifty 50 with some another ETF, with the US Monday 100 ETF. You can hedge with a different type of instrument. It doesn't need to be the same instrument.
Can you explain this with one example?
Yes, we will. Don't worry about hedge. We will come to that. I want to define the terminology first, so that everyone understand, what different types of options are. Because I have to use call and put, and we need to define those terms first.
Okay, thank you.
Sure. And what is your name?
Sir Rahul.
Okay, thank you. All right. All right. Next thing. Remember, I already talked that buyer has the right and a seller has an obligation. When you buy a position, it is also said that you are long that position. When you buy an option contract, you are long that option contract. When you are selling an option contract, when you are a seller of an option contract, we say that you have written a contract. And you can imagine this is derived from the old insurance type of industry. So when you are writing a contract, then you are the seller of that contract. Hence, selling is called writing. So buyer is long that contract and he has the right to, for that contract. Seller who is writing the contract, he is short that contract. If you have sold something, that means you are short that contract, but you have an obligation to fulfill. Buyer is paying the premium and seller is receiving the premium. Are we okay, guys?
Yeah.
All right. My question to you is, I'm just trying to think. Okay. Let us say, let me see what the next slide is. Okay. So now, so far, everything I have said that is applicable to both the two types of options, call option and put option. Now I am going to differentiate what a call option is and what a put option is. A call option gives a right to the buyer of that option. Buyer only has the right, and he always has the right. Call option gives the right to the buyer of an option to buy stocks for that contract. One contract may have X number of stocks, lot size. So that many stocks he's going to get at the strike price. I'll repeat. Call option gives a buyer of that option contracts right to buy stocks at the strike price. Does it make sense, guys?
Once again, please repeat, sir.
So call option gives the right to buyer to buy stocks at a given strike price.
More generically, we can say to buy the assets. I mean, it could be stocks or it could be commodities or anything else.
I'm sorry, say again, please.
Call option gives the right to the buyer of an option contract to buy assets. I mean, it could be stocks or it could be something else.
Sure. Buy the underlying asset at a given strike price. So, is everyone okay with that definition? That call option gives the buyer a right to buy stocks because of that contract at the strike price.
Sorry, the strike price was the price at which level the stock was when you bought the contract, or what you predicted the price would be when you bought the contract?
At which the contract he has.
Okay.
We are not talking about predictions. We are not talking about the directions. We are avoiding those terms for a very purpose.
So, sir, maybe give an example so it will be clear.
So, guys, I have two requests. I just see three faces. If you're asking a question, at least turn your video on. And if you are in a situation where you cannot turn the video on, at least share your name and name or something, because I do not see who is speaking here. So, but please turn the video on if you're asking a question. Otherwise, it's just very hard for me to understand. I can answer it better if I see you guys. Yes, I'm sorry. Now go ahead, please.
Yeah.
What was the question, guys?
Sir, if you can give an example of call option and the strike price, that will be helpful.
I'm sorry, I missed that. Can you please say again?
If you can give an example of what strike price and a call option, that would help.
Yes, 100%. So let us say Nifty is trading at 25,400, 500. Let's assume that. Let us say I have a contract for expiring today. I have a contract for 25,600 call option. All right. Nifty's current value is 25,500 and I have a call option whose strike is 25,600. Now think about that. Does it make sense for me to buy Nifty? I'm going to, because of my contract, I have a right to buy Nifty for 25,600. Is that correct? My contract allows me to buy options for 25,600. But the market price is 25,500. So would I want to exercise my right and buy Nifty for 25,600?
No, you wouldn't.
I wouldn't. So in call option, if the stock price, market price is lesser than my strike price of the contract, that option is a waste contract. That option is a waste option. It is worth nothing. Is everyone clear with that? If I have an option contract, if I have a call option contract and I'm the buyer of that contract, And if the strike price is more than the market value, then I would not want to exercise my contract, my option, because I can buy that share at a cheaper price from the open market. Does it make sense, guys?
Yes, sir.
Yes, sir.
Okay. Now I'll complete this example. Think about that. I have an option contract for 25,400 and Nifty is 25,500. Would it make sense for me to buy it from the market, or would it make sense for me to use my rights from the option contract?
Options.
Yes.
Right.
Use the right.
As a part of owning a call option, and because I have a right to buy Nifty at that strike price, and strike price is lower than the market, I have a right to exercise that. The good thing is, I do not need to worry about that exercising the right. Exchange does that for me. Exchange will automatically give the lot size equivalent number of shares to me for 25,400. But the current value is 25,500. So I will get that many shares, 65 shares for 25,400, and their current value in my portfolio will be 25,500. Does it make sense, guys?
Yes.
Yes.
Yep. Question.
Yes, please.
Sachin.
And thank you. Thank you guys for it. Just makes so much easier for me, and I get to see you all.
Yeah. So, but the strike. So you're talking about the expiry day, but the strike price is decided on the day when you actually, buy that option.
Yes, 100%. Strike
That's
price is
where
fixed.
that's where the prediction comes in, right? Basically, if you think that, am I getting it right or not?
No, you are correct. I'm just differing the use of word predictions and profit because it sets up in the wrong direction. That's all. So do not think that we are trying to predict right now. And the reason is, when we go about predicting, we'll be wrong all the time. No one gets the market right when we are predicting. But when we use the risk defining, when we design the risk, then outcome happens. So the right way to think about options, at least we should start that way, and then we'll go back, to profit and all that thing afterwards. So when you're buying an option, the expiry date is defined at that time. It's fixed. It's not changing. And the strike price is also defined. For a call option, I have a right to buy shares, but I will right to buy shares only, I will exercise, or my right will get exercised only when the strike price is lower than the market price. Otherwise, it wouldn't make sense for me to exercise my rights. Does this make sense, guys? This is the only difference, the condition that for a call option, I get the right to buy shares. And I will buy shares only if my strike price is less than the market price. Otherwise, I wouldn't buy it. Is everyone okay, guys?
Yes, sir. But just a thing. Can you see me?
Yes, please. And thank you so much, guys. I appreciate that.
Yes, sir. So that means it will be done automatically, right?
100%. You do not need to worry about the mechanics of it. Yes.
If my criteria is less than the whatever the Nifty is at in this example, it will be automatically executed. So I need not worry about that. And if it is out of that, it will not be executed. As simple as that, right?
Exactly.
Okay, sir. Right. Thank you.
Yes. Now, if you guys are okay with the call option, I will go to the put option and I just have to change one statement. Everything else stays as it is. Are we okay with call option, guys?
Yes, sir.
Yes.
Alright. The condition in call option, the right in call option is a right to buy shares. The right in a put option is a right to sell shares. And the way to memorize is that C stands for call and B, which is next to C, gives you a right to buy. So for call option, there is a right to buy, and for a put option, the next word is, the next alphabet is S, you get the right to sell. For a put option, the buyer of a put option gets the right to sell a stock. The buyer of a call option gets the right to buy stocks. That automatically means that a seller of a call option, right, buyer gets to buy it, then the seller of a call option has to sell shares. He has to produce shares so that buyer can buy it. That is his obligation. The seller of a, I'll repeat everything again just to make sure we all are very clear. This is the only difference. Everything else is very easy. There's a call option, there's a buyer, he has the right. His right is to buy shares at a given strike. He will buy, his right will get exercised only if the strike price is lower than the market price. Then only it makes sense. And if the buyer has a right to receive shares, then the seller has an obligation to sell shares at that strike price. When Nifty is 25,500 and the strike price is 25,400, the buyer will buy shares for 25,400 from the seller, and the seller has to sell shares for 25,400 to the buyer. Who the buyer is and who the seller is, you don't need to worry about. That is mechanics. That happens, we don't need to worry about any of those things. Are we good with call options definition, guys? All right. Yes. So now with a put option, the only difference is put option gives you a right to sell shares.
So a question, sorry to interrupt, but then does that mean the availability of call options are limited by the number of put options in the stocks that are available in circulation there?
बिल्कुल नहीं. It all depends what the market sentiment is, how people are defining risk. Remember, for each call, there is going to be a corresponding seller. A buyer will have a seller, so you will have both sides always. Otherwise, there is no contract. The contract becomes active when you have a buyer and seller for a given option type. So for a put, are we okay?
Sir, one question. So there can be cases like, I mean, hypothetically, just to understand, there can be cases where there are higher buyers or higher sellers, and we are stuck that okay, no matching is done, so no contract is written, even though there is a buyer.
Sir, you are technically not a buyer unless you have a contract. You are a buyer in line, perhaps, and if there is no seller, then you don't have a contract. So that is possible that there is like enough interest, and if there is no one on the other side, then there is no contract. Has set in yet. That is
got
possible.
it. Yeah, yes. That's what I wanted to. Yeah.
The thing is that market maker, it is his job to produce liquidity, and they do a good enough job that we don't need to worry about having a seller on the other end. There is going to be for liquid majority of the situations.
Mm-hmm. So I have one question. At the time when contract is getting built, is the seller and buyer fixed at that very point of time and cannot be changed at any point of time?
Contract is built automatically by the exchange based on liquidity. They have seen the pattern, whether it's a very liquid stock, how much interest is in there, and they create that. It's already well defined, and we don't need to worry about it.
Okay, so if if I have the contract as a buyer, can I move it to someone else if they are interested to buy it?
Remember, when you have a contract, it will get exercised on the expiry day, but before that you can sell it anytime. If you have sold a contract, then it will get exercised on the expiry day, but before expiry you can buy it again to close it. That happens. Remember, the option is a zero-sum game if you wait till expiry. It is a skill-based game if you buy or sell before expiry. Trading can happen with options, and that is where risk management comes in, and eventual profits.
Makes sense.
So Anil, when you enter a contract, you actually enter into a contract between yourself and the exchange.
No, you don't need to. You see, I have not said that thing, and we don't need to worry about it. Whether it's a market maker or whether it's a individual person, you or anybody else, it's irrelevant to me. I have someone on the other side of the fence. That's all I care about. And exchange will ensure that he is going to fulfill the obligation if need arises.
Okay.
I'm sorry, go ahead. Yes, please.
I'll just a layman understanding. What I feel is call option is that I am entering into a contract of call option thinking the X stock price will go up on the expiry. Am I correct, sir?
That is the general tendency. That is how we, buy it. And I just want to defer that thinking for now.
Okay. Well, just I'm trying. No, just I'm trying.
You are absolutely correct, sir.
Yes, I'm trying to understand the transaction wise. Whereas the put option means I am entering into a contract thinking that if the share price is, say, for example, 100 rupees, on the expiry it will be 90 rupees or 85 rupees.
That is a simpler way of understanding it.
Okay, fine, sir. Fine,
that is correct. The problem is I can be creative and I can take complete opposite thinking and have the same position. That's why I just want to avoid that. But in general, what you said is exactly right, and everyone does it following those words only.
Sir, one question. So, who defines the expiry date? Who defines the expiry date?
That is set by exchange. These are standard contracts.
Okay.
If it is a non-standard contract, you define it. Or anyone who has like a $20 million gets to define it. For a standard contract, it's a job of CBOE or whatever in India is. They define, these things.
Okay.
Does it make sense? Are you guys?
Yeah.
All right. So call option gives the right to buyer to buy stock, and he will buy stock only if his strike price of the contract is lesser than the market price. Put option gives a right to buyer to sell the stock, but he will sell only if the market price is lesser than the strike price. And now let's talk about the example. Let us say Nifty is let's take some stock. Let us say Apple is $200 right now. I have bought a put option for $190, whose strike price is $190. I'm a buyer, so I have a right to exercise it, but I would not want to sell shares for Apple for $190 when the market price is $200. So, in put option, the right is useless, or you will not exercise your right if the market price is higher than the strike price. In call option, it is the other way around. Whereas, let's say another scenario, Apple price is 200 and the put option you have is of 210. In that situation, you want to exercise your right to sell Apple for 210, because in the market you're going to sell for 200. So you have an option contract and you want to sell, your right will get exercised automatically, and you will eventually end up selling Apple for 210. And what that means, that the buyer of that means that seller of that put option has to buy shares at a higher price than the market price.
So, unless one question.
Please, Ray, go ahead.
Yeah. So, in that case, as a buyer, if the conditions are not favorable for my contract, I have an option to not to exercise that contract. The only penalty that I pay in that case is the premium that I paid.
That is correct, and I'll just tweak one word what you said. It is not It is not a question of. It is where the criteria is not met for a call option, and the criteria is that the stock price has to be higher than the market price. So if the criteria is not met, then the condition that the share exchange will not happen. If the criteria is met, then the share will come to your account for that price.
Yeah. So I mean, at a very high level in layman terms, isn't this seemingly always fares a buyer because he doesn't have a obligation and he can exit the contract if the conditions are not favorable, whereas seller has to honor the contract no matter what.
Yes, remember, both can exit the contract at any point in the life of that contract. Buyer can sell and seller can buy it to close the position.
Okay.
Only on the day of the expiry, the exercising happens.
Yeah.
The right will get exercised on the day of expiry and the obligation needs to be fulfilled on the day of the expiry.
Yeah, but closer to the expiry, I get as a buyer, I get a fair idea of where it is headed. So I have a very good chance of getting it right, and therefore I can exit the contract if the price is not favorable.
100%. Yes.
I think we'll go ahead a few more. I mean, doubts will be cleared and going ahead.
So, guys, the problem is we have the most starting. Okay, let's continue. Are you okay with call and put options, guys? Many of you, if you see the video again, you will understand it very clearly. I cannot think even an iota of doubt you will have if you just go through the discussion. We already finished it. All right, I will move. Put option, we have talked about it. This is a screenshot of, you can see the Nifty. This is a Nifty contract. In the middle, there are the different strike prices. On the left side, there is a call option. On the right side, there is a put option. And you can see there are different strike price. And this is for, February 17 week expiry. All right.
Just one question. In put option, is it right to buy or obligation to buy?
I'm sorry, who is that? Can you tell your name, please?
Sir, this is Rajat.
Rajat, go ahead. Yes.
My question is, in put price, in the put option, is it right to buy, right to sell, or option to sell?
No, if you own a put option, you have a right to sell. P is come next to S, so put option gives you a right to sell.
It's not an obligation to sell?
Obligation, no. Put option gives a buyer right to sell, then the seller of the put option has an obligation to buy. Buyer is selling, he's selling to whom? He's selling to the seller who has received the premium in the beginning.
Okay. Okay.
Are we okay, guys? Yeah. So this is option contract, which you can see. There's a next slide. You can see the lot size. A one Nifty contract has a lot size of 65 over here. Similarly, different instrument, different assets have different lot size. Guys, this is how, if you are doing, this is how, another way of looking at an option contract. First line, -1 means that you have sold. Minus means you have sold it. You have an obligation. You are short. You have written that contract. -1 means one lot you have sold. Nifty is the underlying asset. It is the Nifty for which this contract is about. 25,300 is a strike price, at which, if the criterion is met, the exchange will happen. What exchange? That depends on the type of option. This is called PE. PE means put European. We use European options. This is a put option contract expiring on February 24. These are weekly expirations. So February 24. And what is the strike price of the first option, guys? I'm sorry. The strike price of the first option is 25,300. The premium for the first option, which the buyer has given and the seller has received, is 110 rupees per contract. 110 rupees per share, and in one lot there are 65 shares, so he would have received 110 into 65. Are we okay, guys?
It doesn't say when the contract was done.
No, it doesn't matter. It could be any time. What we need to remember that the day of the expiry. We just need to know what is the day of the expiry, because that is when things will happen. Before that, you can buy any time. That is not needed, basically. Similarly, in the second contract, there is a +1. It means you have bought one contract. The contract is for Nifty, that is the underlying asset. Strike price is 25,500. And what you have bought, it's a call option. C means call European options. Expiry is March 30, and the premium you have to pay is 660 rupees into 65. Are we okay, guys?
So one question.
Please.
Who is deciding this premium? How much it should be? I mean, so call option for the buyer, he has to pay 110 rupees premium per share. Correct?
No, call option buyer has to pay 660 rupees.
Okay.
110
so
is
option.
the premium for the PE. Put option.
So buyer has to pay 110 rupees. Correct?
For the put option, buyer has to pay 110 into 65. Correct.
To 65 for that contract.
Yes.
And who is deciding this premium?
So everything I have said so far, it is pretty static. Okay. The only game which one needs to understand is the premium.
And it is static, right? I mean, it won't fluctuate with.
It is not static at all. It is governed by variety of factors. And in options, the only thing which is once we understand the basics, right? So far we have covered the basics. What is important to understand, and I will bet you not many people, even the options professionals or people who are using options, understand how the premium gets decided. And that is what I want to cover if the time permits. I do not know, but we will see. All right. So this is how you can read the option contract. What you will see here, that first, the most important bit and the most confusing bit over here is what the gentleman just asked, is the pricing. We do not know about the pricing. And options is all about understanding pricing. Option is not about figuring out the direction and buying put and call. That is gibberish. You need to know how option pricing is happening. If you understand that, then you will get a sense of risk. So the purpose in this call I want to finish is option pricing, but it's already 1.5 hours. We will see as far as we can go, and then we'll just give some time for Q&A. All right. Ignore this chart. By now you should know that put is sell, call is buy for the buyer. For seller it will be opposite. What you may remember, that so far I have not told you that buy call option the market is going up, or put option and all that thing. That is not important. What we need to understand, that how these options are priced. Can anyone tell how these options are priced? Ajay, people are not waiting, right? People are pinging me still, I guess. They're okay, right? People are in right now, right?
Some couple of people are there. I'm admitting in. No waiting is there.
Okay. Thank you, Ajay. Thank you. Yes. The most important bit is to understand how options are priced.
It is decided.
I have read a little bit. Market sentiment.
Yeah.
I'm sorry.
There is an important element in this option premium pricing is time value.
Okay, very good. Yes. Anything else?
Uncertainty, risks.
Very good. So let me tell you. I will tell you an intuitive way of thinking these options pricing. Okay, and that is option premium, which we were talking about. That consists of two parts: moneyness and the potentialness. Can you guys tell me what moneyness is?
How much money can be made?
Liquidity.
We will not talk about profits in this class.
Size of asset.
Liquidity in the market
per unit.
And I'm sorry, I misstated. I have to talk about profit, but in a different way. No, it is not the size of the asset. Anything else, guys?
It's the current value of the strike price, how lucrative is it with the current status of the underlying
That is
asset?
100%. You are 100% correct, sir. Moneyness means that if I exercise this option right now, how much profit I'm going to get. So let us say the Nifty example, call option, Nifty is 25,500 right now, market price. I have a call option which gives me a right to buy for 25,600. What is moneyness? How much moneyness is in this option contract?
Negative.
0.
Any other guesses, guys?
Minus 100.
Price into premium.
Remember, Nifty market price is 25,500. Nifty option contract price, strike price is 25,600. How much moneyness is there in it right now?
There will be certain moneyness because of the potentialness.
But we are not talking about the potentialness, we are ignoring it. It is the day of the expiry. It is 0. How much moneyness it is? We are talking about what if option get exercised right now. So there is no potentialness.
Minus 100.
Minus 100 is going to lot size.
Very good. These are good guesses, guys. But remember,
65 into the.
Remember, that would have happened if it was a future contract. Here, you don't need to exercise your right if it is not meeting the criteria. The moneyness, the profit in this option contract is 0. Hence, the moneyness in this option contract is 0. Moneyness tells you how much profit you have right now. Absolute, not the losses. How much profit you will have if the option get exercised right now. Now, I'll change it. Let us say Nifty is 25,500 and the option contract you have is 25,000. How much moneyness this option contract has?
500.
Correct. 500 and the total value is 500 into 65. If this is the situation is on the expiry day, then at time 3:30, this will be the value of this option contract. Does it make sense? We have figured out the pricing. What the gentleman was asking, we have figured out the pricing on the day of the expiry for any given contract. If the pricing is different, there is an arbitrage opportunity. If the pricing for this option where the profit is 500 is different, right, is different than 500, if different than 500, you can use arbitrage and make money. But this is only if the option gets exercised today and right now. Are we okay, guys? Alright. Same thing happens with the put option. Right? If the Nifty is 25,000, right? Nifty is 25,000 market price and the put option you have is 25,200. What is the moneyness in that contract?
200.
0.
200, right?
200. 200 because you are going to profit for that 200 rupees into 65 right now. You don't want to sell in the market price. You have option contract at a higher price. You would exercise your rights. And that is the moneyness. How much money you're going to make right now? If Nifty is 25,000 and you own the put option for 24,900, how much moneyness that option has?
0.
Zero. It's useless. You don't want to sell for a lower price when the market price is higher. Is it getting confusing, guys, or we are still on track?
It's clear. Not intuitive, but clear.
I tried to be intuitive. I'm sorry.
So basically, moneyness cannot be negative. It will be always positive. It can be
Absolutely. Moneyness is about how much profit you're going to have. It's the absolute value of the profit, basically. Correct. You were talking about intuitive. This is the academic way of thinking about options premium. Intrinsic value and the time value. I prefer this thing, and this is again, I created this thing because it just tells, what it is. Time value tells. We will come to a time value next. Let's wait for this, guys. You can take the screenshot. This is what you should, solve and share it if you want in the options group. It's a simple thing. You all should be knowing by now. I don't need to. What I want to tell you guys, that whenever the intrinsic value is 0, whenever I will take it one clarity, guys. What the numbers we came up with for the profit and loss, that is the intrinsic value actually. Moneyness is a little bit different, and I'm going to define that now. Okay, moneyness tells us the intrinsic value. If the intrinsic value, if the option can get exercised and the intrinsic value is 0, it is called at the money option. So if I say in the first scenario, option can get exercised, strike price is same, intrinsic value is 0. But the moneyness, it is called at the money option. In the second scenario, if you see, the right to buy is at 110, so the intrinsic value is 0. That is called, in those scenarios, when intrinsic value is 0 and the strike price are different, it is called out of the money options. And when intrinsic value is positive, that is called in the money options. So moneyness tells the type of intrinsic value you have. At the money, when both things are equal, strike price and the current price, and intrinsic value is 0. Out of the money, when for call option, when the intrinsic value is 0 and both things are different, it is out of the money option. Strike price and the market price are different, it is out of money. When intrinsic value is positive, it is in the money option. A stock, the option will get exercised on the expiry only for at the money or in the money. For at the money, there won't be any change because the intrinsic value is 0. But it can get exercised depending on certain factors. But for in the money options, there will be some intrinsic value and your position will have that much benefit. Does it make sense?
Sir, I have a question.
Please.
Why are we avoiding the term profitability here? Because ultimately intrinsic value is what we are looking at and it's the profit only.
The problem is when we talk about profitability, we want to go look to make profit. We don't want to understand the risk part. Then we forget about risk. How many people in the options, who talk about options, talk about the risk part? We just talk that if Nifty goes up, we will make profits.
Yeah.
And the problem is that is the wrong way of thinking. So here, moneyness tells whether it's at the money option, in the money options, or out of the money, and how much profit you're going to make today, that becomes your intrinsic value. Only in the money options get exercised on the expiry date. Are we okay, guys? I hope you are not sleeping. I'm sorry, just make sure.
Sir, we need this side. I have a doubt.
Yes.
Sir, just 10 minutes back we discussed. Let's assume we discussed a 25,500 option.
we said the moneyness will be 100, 500. We discussed those two options, 0 or 500. Now we are going intrinsic value. Is it the same thing or is it?
Yeah, I'm sorry, I misspoke. What I was, that value is the intrinsic value. If intrinsic value is positive, then moneyness is in the money option.
Got it.
Yes.
That's the clear. Thank you, sir.
Sure. Any other questions, guys? So, a homework for you is fulfill the sheet. Add the money, in the money, or out of the money, and find out what the intrinsic value is. Similarly, we can do for put options. And you can see, there's a typo over here. I copied the slide, and it should be right to sell. It should not be right to buy. I copied the same slide, and in second slide, moneyness P, it is a right to sell options. So use that, and again fulfill the sheet. Add the money, in the money, and out of the money. See, once you do this exercise, you will start intuitively know what option position is going to do. You don't need to look at the charts and graphs, line graphs and all that thing to figure it out. You will just know what is going to happen with this option position. Are we okay, guys?
Yes, sir.
Alright, so what I just said, this is what is in this chart, and you will see how messy this is. Even though it's the cleanest chart, it is still confusing. And this is the put option moneyness. This is a good chart, one of the best chart I could find, but still it's messy to understand. I want you guys to intuitively understand like what we have discussed, and then you should be able to tell whether it's in the money, out of the money, your right and obligation and all that type of thing. I want to skip it. Let's move. The second part of that option premium, remember, moneyness tells what if I exercise the option right now. Potentialness tells that what is the potential of this option to be in the money, where it will get exercised. What is the possibility of this option? Which depends on the probability, right? Intrinsic value is certain as of now. This is all about the possibility of the future, in the future. An option premium consists of two parts: intrinsic value, which is the moneyness, and then the potentialness. Guys, how many of you have gone completely bored and tuned out from this discussion? So that I need to know, if we are completely out, then we can do we can just go back to the Q&A or something like that. I want to make sure that we are following so far.
With you, following.
No, we are following, yeah.
Yeah, following.
Okay, so I have not gone completely off track so far, right?
No.
Alright, so I'll trust your word, and we'll finish the potentialness and we leave 10, 15, 20 minutes for the Q&A, okay? And I'll keep it very simple. Potentialness tells, assuming, and this chart is very simple. Here, imagine that there is an asset. I'm selling my house, okay? I'm going to sell today, and I have considered different scenarios after 1 week, 2 weeks, 1 month, like that. Moneyness is 0. What that means is that I want to sell the option today. Think about, let me just go back. If I want to sell my house today, my house is for $100,000. If I want to sell my house today, how much you should pay me?
$100,000.
$100,000. It's just very natural thing, right? If the moneyness, if the strike price and the market price is same and time is 0, there is no potentialness. But now my house is for $100,000 and I want to sell you that house 1 year from now, okay, assuming it is going to remain for $100,000, how much you should pay me?
Because there is a probability of
$100,000.
But why would I sell it for 100,000? Think about it. Why would I be in a contract when you are going to buy the same thing 1 year down the road? There has to be some incentive for me. I would sell it to someone.
Sorry, and the interest basically.
Exactly. It is the interest. If you want, I mean, there are a lot of other complications, but we can say at least, let us say market rate is 6-8%, and then maybe 10% is a good enough price. FD rate is 8% or 6%, then assuming for sake of simplicity, 10% is a good enough price for me to hang on in this contract with you so that you can buy it 1 year down the road. Is that fair enough to say, guys? There are option premium for any contract when a strike price is the same as the current market price for 1 year down the contract should be between 6 to 8 to 10%.
Yeah, correct. It depends on the potential of that asset.
Well, I'm saying that it will be same price that I'm giving it to you right now for sake of simplicity. There is no price change happening. Price is going to be same.
The premium basically will give me option to buy or not.
Exactly. You may decide not to buy it. I mean, that can happen, right? Or whatever, basically. But the premium which I should accept from you has to be 10%, 8, 9, 10%. If I'm asking 20%, it is too much. If you're giving me 2%, it is too less. That option, you don't want to be a part of that option. What I'm trying to, guys, make you think how the option premium works based on different expiry. Now my question to you is, assuming that we agreed that for 1 year time that premium is 10%, what if that contract is for 6 months? Is that premium going to be higher or lower?
Lower.
Exactly.
Lower.
Yes. For a shorter time, the potentialness premium, assuming everything else is same and Mr. Trump is not tweeting anything else and all that type of thing, volatility is not changing. What about if the option is 1 month down the road, expiry is 1 month down the road, premium is going to be higher or lesser?
Lesser.
Lesser. For 1 year it's 10%, for 1 month it will be 1%. What if it is 1 week, expiry is in 1 week?
Even lesser.
Even lesser. 0.5% to 1/4%. You see how if we are expiring the option right now, the potentialness is 0. What if the option is 2 years down the road? How much time premium it should have?
20%.
Exactly. 10% for 1 year, maybe 16% if you use compounding and all that thing, right? What I'm trying to show you guys, that there is a way to understand how premium is derived and to understand whether this premium makes sense or not.
So, sir, if we simplified, can we say it is directly associated with the risk associated of holding that asset for that long?
100%. It is not only risk, there are like 20 other things which come into the picture. In fact, the model, the formula who created this formula, the method to find the value of this option, the Nobel Prize has been given to him. Mr. Black, that is called the Black-Scholes model. Fisher, Black, and some of you are expert on the Black-Scholes model, so I will not go there. I have it somewhere in the sheets. I'll show it to you. Nobel Prize was given to them who created the option pricing model. I will tell you, if they have figured out my way of pricing, they would have followed my way actually. It was simple. The formula which they have come up is, let's see if I can find out. This is the actual formula which they have come up, which is how the option pricing is determined. But we can determine it based on the moneyness and the potentialness and it will be a very good approximation. Are we okay, guys?
Yes, sir.
All right. So, guys, I have. Let me go back to the. I think potentialness. Yes. So now, based on that, you can fulfill this sheet also. Assign, take any number. Number is not important. The trend is important. That based on the day of expiry, whether the trend is right or not. Fill this up. If you have done these two parts, you know how an option premium is decided based on moneyness and based on potentialness. Moneyness is about right now, potentialness is about the future. The possibility of that option, and for that, how much premium. Again, the complexity of this is we cannot fathom. The real complexity is not worth knowing. This much understanding is absolutely needed for everyone to follow. Are we okay, guys?
The spot price is current price, right? At the moment.
Exactly. Yes. And assume that there is no external macro events. So volatility is going to be same. Are we okay, guys?
One question here.
Please.
With volatility, generally the premium tends to increase or
See, it will
reduce?
change.
Because
It will change and it will increase actually. But then problem is there are so many factors. That is an academic thing. Based on this class, you will not pass any exam, to be honest. But I can tell you, based on this class, you will become a very good option trader. So there are other things, but we want to keep it very simple in the first introduction class. Are we okay, guys?
Yes.
Yes. All right. So we will come to this thing. You can just see the same thing which I have taught you in the potentialness. This is what is happening. As we come close to the expiry, the potentialness, which is also called the time value, which one of you said it earlier, reduces to 0. And we have already derived it, from 1 year premium, 6 months premium, 1 month premium, 1 week premium. Right now premium is 0. Are we okay, guys? All right. These graphs are complex, but I don't understand with graphs. You can see how the red part is the potentialness, and that differs, that changes based on different circumstances. All right, let's see this thing. We often talk about Greeks and all those things. It is important, and perhaps we'll talk about that. Because of time, I'm going to ignore it right now. It will make things complex. I want you all to kind of go through this discussion. Make sure you imbibe it. It should become a part of your second nature to tell immediately what the potentialness is and what the moneyness is and what should be the premium. Market price will not match, but it will mirror. It will be in the similar fashion trend basically.
So just explain in short what these Greeks are. I mean,
so a lot of these things, there are 5 Greeks. Remember, Greeks do not determine the prices. Greeks is the outcome of a change in price. People generally will think otherwise. Think about it as this. Black-Scholes model is a very complex model. If I have to ask you to calculate the price, you will need Excel and many other things. On your own, you cannot calculate. So we cannot trade based on Black-Scholes model. Traders cannot calculate that value and we cannot trade that. So Black-Scholes is a curve. It's a ununiform curve. These Greeks are a slope of that curve. Slope we can calculate, right? We can differentiate and these are the partial derivatives of Black-Scholes model. It's very easy to understand the slope. The curve is hard. So trading happens by looking at the Greeks. And there are 3 or 4 or 5. Delta is very popular. Think of a delta as a possibility of that option expiring in the money. That is the simplest definition. Delta tells what is the possibility of that option expiring in the money. Theta tells how much potentialness you are going to lose because of a 1 day less in the expiry. If expiry is 10 days away and theta is 0.01, then 0.01 into the lot size, the lot size, you will lose by tomorrow. Similarly, there's a gamma, vega, rho, and all. You do not need to know that at this level. Perhaps when we talk, maybe people who want to be a full-time trader, for them, it needs they need to know and understand these things. But for class 1 and class 2, you will be just fine by knowing delta and theta. Are we okay, guys? I will not hold you any longer, so let me move on. This is the one-page recap. Call is a right to buy, put is a right to sell, buy means long, that gives you a right, right, selling means right, that has an obligation. Naked is where you are not protecting your position. Hedged is your risk is designed the way you want. Option price has two parts: moneyness, which is the intrinsic value, and the potentialness, which, as you were saying, that is like a time value, right? I want you all to fulfill this sheet. Take a look, make a copy. I can give you the solution also. I think this sheet has a solution, I think, for one of these things. You don't need to take a look at the solution. Try fulfilling it. If you can do that, trust me, you know more than people who are trading options. Are we okay, guys?
Yes, sir.
Yes.
All right. So we finished basic options class. We did not talk about any strategies, guys. We just learned what options are, what is the difference between different type of options, and how can we price option in a simpler way. A strategy is a very easy thing. Trust me, I could have skipped all these things, and in half an hour I could have taught you 5 different strategies which you can use. The problem is you would not have been able to come up with a 6th strategy on your own without knowing the basics. I can tell strategies for every day of the week and every week of the month. But again, if things change, you will not be able to come up, you will not be able to respond to a situation unless you understand how option pricing works. And you don't need to be complex. You just need to understand in a very simple way. All right. Nothing else. This is the model which we don't want to see. We don't need to know henceforth from here onwards. If any of you want to take, I just created one thing. Take a look, copy this thing. We have many experts here, and if you want, figure out some strategy based on these things, and this will work. Strategy, and go to Sensible or your Zerodha account and form this strategy and see if you're okay with the risk versus reward. I have deliberately given you exact numbers because then you all will pinpoint to that number and immediately that strategy becomes worthless. If all of us are jumping to the same strategy, it doesn't work anymore. So I have given it based on the probability it will show and the risk versus reward. You all can create your own different strategy. Having said that, in the next class, if you guys like this much and if you guys want the second class at some point of time, I will tell you maybe 3 or 4 or 5 strategies which you can use in perpetuity. Does it make sense? Okay. So see, if I just tell you the fixed things, then that strategy will stop working because people will start sending market order and all that thing. It won't work for anybody. But if you all create a different version of this strategy, you all will be fine. All right. This is the same screenshot I think I shared earlier, I believe. Option, this was our class, same instrument and different outcome, guys. That's all I have.
One question here.
Yes.
Any software where we can do simulation before we do the real thing?
Yes, many. I mean, options, Omega is in US, Opstra is in India. Opstra, many people use in India. Opstra, you can use it, and that's very popular in India.
But like, sir, you have experience of 2 decades, then only you are not using. But for beginners,
I'm sorry, what was that?
an experience of more than 2 decades, then you are not using any of those simulation tools. But for beginners,
See, you can use that, but first the strategy has to make a logical sense to you. If it doesn't pass the sniff test, give it a pass. You have to understand, the chemistry of that strategy. So, for example, I have given one strategy, the bull put spread. Some people have made a lot of money. I don't know if Jayesh or some is here, or I have other friends. They've used this strategy, but you need to understand why that strategy and why those numbers I have come up with. And once someone understands the anatomy of that strategy, then it will benefit you a lot more. So it has to make a logical sense. It has to pass the sniff test. Problem with back test is it's always about the past, and future is going to be different than in the past. If there was a one fixed strategy, then someone would have been the richest person in the world already following that strategy. There is none. What worked in the past, it won't work. Any strategy doesn't work more than 2-3 years. It becomes so popular. If a strategy is good, it becomes popular, and once it becomes popular, it is not good anymore.
Sir, two questions I have.
Please, sir.
Yeah. So one is what you just said, that what you said bit before, that you need to look at how the options are currently being priced in the market. What is the premium going? I mean, any specific reason you are stressing on that? That why we should be following the premiums for that? Because I don't have much control over that. We are not makers. We can't decide that.
You can decide how much you're paying for it. You can decide if there's an arbitrage opportunity or not, or not. If a 1 week option is priced with 20% money potentialness, I mean, that's a ridiculous option. You don't want to be a part of that. You don't want to be a buyer of that option.
Got it.
The problem is, it's very easy to teach strategies, but you will not be able to solve a new problem with those strategies unless the basic background is there.
Yeah, got it. And second, more on the understanding side, do you believe that options or setting positions on options would impact the underlying price as well? I believe that happens, but like say Nifty options, if there are too many call options at some strike price, will it impact the underlying behavior as well? Because then people start thinking like, okay, it will go up and up, so it's kind of go into cycles.
Unfortunately, it does happen, and it's a positive feedback loop or a negative feedback loop. These sentiments, they drive many things. That does happen. That can happen actually.
Okay.
Acha, Anil.
Yes, sir. And thank you for being here, sir.
No. I'm very enjoyable. I'm so happy that so many of our alumni are taking interest. I was thinking, Anil, suppose we go back like a use case, maybe a 2-year-old or 1-year-old data, actual data, and how you thought of the strategy. So it is the past data, okay, but as a use case, I'm saying you do that. Is that possible?
100%, sir.
And you can use it on American data also if you feel, or Indian is better. But if you want to use that, you are more comfortable with American data. But I'm saying just like a case study or use case, you can do it if it's.
I can do that. Maybe I never took subscription to any of these things, but maybe for the next class when we talk about a strategy, I can produce the data also, sir.
Acha, a totally different thing from options and money. I am all for prosperity, though I am from Bengal. But I was thinking, Anil, if some of us in this group are interested, I want to take a half an hour session on how to be even more happy. That's a session I want to take from the Bhagavad Gita. So it will be, the aim of life is money, prosperity, and happiness. So I would like to. So Ajay, do you think they will take us for this kind of thing? How to be even more happy? Ajay?
100%, sir. You decide the timing, and a lot of people will be, glad, happy to be a part of that thing.
Mane, it's more of, I've done this in my MBA classes, how to do stress management, and now from the Bhagavad Gita, how to manage joy and joy and happiness.
That will be really helpful in this turmoil, sir. For the last one.
Definitely,
Ajay, Ajay, for my knowledge, you're 26-year-old. Just from my general knowledge, I'm going beyond options now. I want to understand from a young person like you, how stressful and how difficult you see the next 10 years because of the changes, what is happening in Anthropic, AO, and all that. So where are you working right now, Ajay?
Currently, I'm working in Mediasis, but the last day only I was discussing with one of my college friend. So, what about you? I mean, have you seen the Anthropic, this new technology? So he was like, it's not. I mean, you have to keep on evolving. You have to keep on learning new tools, new technology, and that's what you have to do. I mean, learn new things, whatever is coming. That will be. And also, I mean, apart from job, you have to have some skills so that you have to keep updated.
No, I'm saying, Ajay, ekdam honestly, between this small group, for most, not you, but most of you, are you like a lot of optimism on the future, or you feel AI will take your jobs and there's a lot of, diffidence?
There at back of the mind कि हाँ अगर ऐसा कुछ आ रहा है तो how to, I mean, कैसे उसको use करके we have to be upgraded or updated. Otherwise, at some point of time, you'll be out of technology. Like
यहाँ पर Anil, my concern is, Anil, that it's a survival of the fittest. So basically, all of us will not be able to evolve and adapt to this. Maybe the
100%.
IIT BHU students will be able to do it because they're very good. But I'm talking of the general. Previously, क्या होता Anil? From the very average engineering college, also people are getting to TCS, going to USA, Europe. So I'm saying, Ajay and Anil, for the average guy, it must be very stressful now, I think.
Very stressful, yes.
It is, sir.
And especially Ajay, if you're 20, suppose he's 45, Anil, has a wife and children and fees, expenses are very high nowadays. Exactly. Aspirations are very high, unlike our father's time. Exactly. So ये एक ऐसा सेशन अगर करें हम लोग कि how to cope with this.
Sir, definitely आप कीजिए. You decide the time, and I'm sure a lot of people will show up, and they'll be happy to be a part of that.
And mine will also be very discussion. Like I'm asking Ajay the questions, so I'll give you a question, and I'll ask a question to Ankur. What is your outlook? And Ankur is going to answer, and then we're going to take it forward. And my answers will be not my answers, whatever my answer in the Bhagavad Gita is, because my thinking, Anil, is that the Bhagavad Gita has all the answers. If you can just follow it, it has all the answers. So I'm going to just distill those and try to give it to you, because I want to move to that happiness, joy and happiness.
Sir, please definitely do it. This is a great thought. And you definitely.
So Mayank is writing, it will be very helpful, and Ankur has also said it's going to be very helpful. So yes, Ankur, you have something to say? Ankur, just tell me about how old are you, and it's because we don't know you much. So
Well, I'm not gonna tell how old I am because I look pretty young, I believe.
Acha. So which batch?
But sir, I'm 2004 batch, and Rohit Sharma from my batch is also here. Yes, sir, 20 years. But sir, there are certain life skills which our education system does not teach, whether it's school, colleges, anywhere. I mean, personal finance, being financially independent, what Anil sir is helping us to do, or managing stress. Like stress is everywhere. Whether you accept it or not, it's at your workplace, at your house with kids, and that having the ability to manage that. I think that is a very major skill which we should have and promote how to inculcate amongst each other. Technology has been evolving. No one can stop it. When I was in BHU, we didn't have internet. We had to, jump, what is that, Hyderabad gate, and go to do internet.
Oh, you didn't have internet?
Cafes.
LAN wire
You didn't
At
have
that time,
internet?
it was not. At that time, it was not. Till 2004, we did not have internet in the campus. To today, where we are, where every person in the country has a mobile phone which has a computer in it. Tomorrow, who knows AI what's going to do? And as human being, we have to adopt. And we are good at adopting, but this, how do we manage? And probably a lot of us have not seen, this major shift which can change the way we work. Probably folks that
Guys, I'll just request one thing. Definitely, please share the feedback in the group, whether it was worth trying it or not. This was my first attempt ever.
Anil, I am saying feedback. There's no need to take feedback on behalf of everyone. I am giving a 10 on 10. So that feedback is done.
Thank you, sir. Thank you so much.
10 on 10 plus labor of love.
Thank you.
नहीं अनिल, ये इसको थोड़ा सा सोचिए, हम लोग और भी आगे बढ़ाएंगे गाड़ी को, खेल को और भी आगे बढ़ाएंगे, ठीक है?
बिल्कुल सर.
Sorry to interrupt you.
Because we all need passive income.
Correct. And that is, I think, in this world, as we are talking about changing situations, where job market is going to be tougher and tougher. If people know these things, we should not use, this is not a, wealth creating machine tomorrow. This is not like a lottery ticket, but this can give you some edge, when nothing else is working actually.
Acha, one more thing, my humble suggestion, my way of thinking, that apart from options, all Ajay, Ankur and everyone, we must also be good at doing fundamental analysis. One is option for regular income, and one is be able to identify the sectors. I am expecting, the people who are attending here should be able to identify the sectors. Like, is it going to be electronic manufacturing? Is it going to be the capital goods? What sector is likely to not only 2 years outlook and take long positions in that? Because that is also a wealth creator, right? So jointly, if you can identify the sectors, the other thing, what we should do is, suppose a major event happens, like the USA trade deal is going to be announced, which sectors are likely to benefit? Like, is it going to leather companies? So which leather company? So jointly, if you can identify that, lot of money is possible. Like, for example, if you know that exports are going to get a boost, and we all agree that Gokuldas Exports is going to be one company, then we can buy a Gokuldas Exports on Monday, and that can give you as high as 25-30% return within 1 month or within few days. So on every event, we should be able to, Anil, think which sector and which is the company within the sector. Ajay, is it making sense what I'm saying?
Yeah, perfectly. This is what you emphasize in your message also on the group, that identify the sector and then identify which sector is going to be the next decade. I mean, and then
not decade, Abhi. I think it's 2-3 years only.
Yeah,
so
yeah.
Ankit, you are agreeing to what I'm saying, Ankit?
Yes, completely. I'm assuming it's me, right? Yeah.
Yeah. You. Because I can see you in my screen. So you, yes.
No, actually, lovely session. Though, to be very honest, I'm a very newbie in this entire game. A very newbie in the stock market itself. And I was wondering that is it too early for me to be part of a session like this? And I wanted to take view of Anil on this. That do you see this journey as an incremental and sequential journey of going from a normal? I'm a fundamental investor as of now in stock market, if I can use that term, though I don't think I qualify for that as well. but do you feel that I should spend some more time perfecting that journey, and then perhaps a ladder above is options, or is it something
No.
parallel
Both.
to it?
Both. I totally agree with Anil, and in fact, Anil has encouraged me, but I have not done that. Like, ideally, I would like to go with Anil and have a part of my money into option strategy and get a passive income, and part of my money into fundamental. And what's your age, Ankit, now?
No, I'm I'm 37.
So you are about, in my opinion, about 17 years late. We should all do this by 20. So 17 years late you are.
अच्छा
Acha, I see one
जब
Bengali
जब
gentleman.
जागो तब सवेरा.
I see one more Bengali gentleman, Arijit Chatterjee. Mr. Chatterjee, are you there? Can we see you once? I think you are a senior person. Are you there, Mr. Chatterjee? Mr. Chatterjee is not there. I saw him, I think. Acha. Because it's good to see Anil, people from the Eastern India looking for making money. Because people in Eastern India are very happy not making money. So a Vaibhav Jain will always be interested in making money. So there is no but I always want people in Bengal side to think like a Jaiswal or an Agarwal or a Singh.
Correct.
And in fact, Sanadhya is also a bit, that Uttarakhand hills, so happy go lucky.
True.
Anil is a big, big role model. Yeah, he's retired so early. We all of us dream of retiring early, and Anil has done it. So big role model for us.
Thank you, sir. Thank you so all of you, for staying with us. I hope that you learned something. I hope it was not too complex. I tried to keep it very simple. See, it's very easy to make it complex, to be honest.
Ajay, leave this thought. Like I leave this thought with you. Like you are a young boy, make a 1 rupee minimum people have to pay, and people pay more than that. We'll give it as an honorarium. 50% goes as honorarium to Anil for his drinks and food, and 50% goes to a fund so that we can have, we can invest that. So, and you can be the treasurer of the group, Ajay.
We'll discuss.
Because we have no doubt on the honesty part. So, so Anil needs to be given more motivation. Some drinks has to be given to him.
All of you guys are there. I mean, that's a good motivation for me. I think that's amazing.
No. I'm a very Agarwal Jain thinking type of person. So
that's right thinking, sir.
Is Gagan Agarwal there? Is Gagan Agarwal there? I saw Gagan Agarwal. Is he there?
Yeah,
he's
there. Gagan, just switch on your video. Let me see. I'm happy to see an Agarwal. So Gagan, tell me. Oh, you asked some very good questions, Gagan. How old are you now?
I'm 25.
You think like an Agarwal. Yeah, the questions were exactly the Agarwal types.
I mean, options are completely new to me. Even stocks, I'm very new.
Acha, Gagan, tell me, out of happiness, out of 10, how much will you give yourself out of happiness?
That's a tricky question. I would say that.
No tricks. With me, there are no tricks. Me and Anil have no tricks. How much? 5 or 6?
I mean,
or
to
7?
be honest, I'm unclear on the question itself, to be honest.
How happy are you? Suppose a survey. How happy are you feeling?
So right
how
now,
happy are you
very
feeling?
happy.
No, not now. Yesterday at 9 o'clock. How happy are you?
I mean, it depends. So yesterday was a Friday. I ended up closing my work, so I was happy. If it was not closed by then I might.
Monday 9 o'clock. Monday 9 o'clock.
I'm happy. Yeah. Monday 9 o'clock is probably the most happiest time of the week.
So we should do a survey. I am sure if many of us honestly Anil answer, there'll be 6 or 7 with the anxiety levels and so many things. Yes, that will be a truthful thing actually.
Sir,
Children.
it will be helpful because everyone tells Gita is a good book and a lot of answers are there, but no one tells how to find the answer in the Gita. So if you can tell, that will be really great in that perspective, that it will be helpful for us.
Yes. So that will be my level of love.
All right, guys. We I think it's a lot of people are still there. That's just so amazing. We ran a little bit 20 minutes more. If anyone has any other questions, please feel free to ask. Otherwise, do share. I guess your feedback just so that we can improve.
Sir, I wanted to ask one thing. I never did stock market. I never did option. So how to start this journey of stock market as well as options? Like I understood today's session, but how to start it?
See, I may be a little biased, but I think you just definitely go to the 2 financial classes I have conducted. I conducted only once, and take the feedback from others. What do they think? I did it for my Shobha friends here, and then we recorded it. Then we did it for IIT guys. I think just do that once, and that will be like an options basic class. You will understand a lot more about fundamental investing actually than anybody else. 95% of the people.
But I will, Mayank, for you and for everyone, I'll give an answer to that question. That India, in my opinion, is going to be growing very well for the next 25 years. And if we have to participate and enjoy the prosperity of that growth, keeping money in the bank fixed deposit like our parents will not help. Right? So there will be volatility, ups and downs, but the curve is always up.
Correct.
Until unless there's World War III, then it's completely everything is destroyed. That's a different thing altogether. But there will be volatility, but the curve is up. So Mayank, how old are you?
Sir, I am 27.
Okay, so you are 7 years late. You should all start by 20. Your son should start by 20. So 7 years late, not much. But the good thing is you are, if you work till 60 also, so another 33 years. So you should start tomorrow.
Sure, sir, sure.
And the best part is, unlike Anil, unlike 30 years back when India made, there was a lot of, it's a very well regulated market, India. Start with 1,000 rupees, make some losses. All of us are going to lose some money all the time. So some losses will be there, some wins will be there. So some seed money you start off with 1,000 rupees, and virtual money. If
I
required,
have
start with
invested
virtual
some money, sir, in stock market, but it is just
that was
random.
to andha. That was to andha. And we'll make some mistakes, but overall, out of 10, you should get 7 correct and 3 wrong. Then you make a lot of money.
Yeah. Yes, sir.
Yeah. With that, guys, I will say thank you so much to all of you. Thank you for being here, and I hope you learned something. Even if you understood, few things, I think it'll be worth it. If you see it again, I guess I'm very sure that there won't be anything which you have missed, which is important. I mean, there are things which are not important, but anything which is important, we have covered it. And if you like it, then maybe at some point of time we can have the part 2 of this type of class. So share some feedback, what you thought, how it went, what you like, what you did not like, and then we can decide whether it's worth doing the next version, next part of it or not, basically. I just want to
Anil sir, I would like to add, like, if we can continue or schedule this part 2 session at the earliest, so at least I think we can recall the learnings as well, what we have learned in this session.
Yes, so let's share the feedback of what you all thought, and how it went, and the good and the bad, and then we can plan something next time, basically. And sir, you should also definitely give us a time and date, and definitely plan that session whenever you are ready. With that said, I think we are done, guys. If you don't have any questions, we can just enjoy the day.
We enjoyed.
Thank you so much, sir, and have a great weekend ahead.
Thank you, everyone, and thanks, Anil sir.
Wonderful session.
Thank you so much,
Thank you so much,
Anil,
guys.
Thank you, sir.
Thank you. Thank you, everyone.
Thank you, Anil, for a wonderful session.
Thank you, everyone.
Thank you very much.
Thank you.
Thank you, guys. Thank you so much.
Okay, I'll end the session.
Thank you, Ajay. Thank you.